Yesterday, we saw an official announcement, official declaration from Japan and the UK that they are officially in recession. So that is the after the fact declaration when the country has already been in recession. So when you say a country is in recession, that means the 2 consecutive quarter of GDP contraction. So those countries have already seen 2 negative GDP growth consecutively. So that is the after the fact declaration where the economy has already been contracting. Okay, Germany, which is the center hub of the economic power in Eurozone, has already announced they were in recession last year. But their stock market index, the DAX index, has been all-time high. Japan stock market is all-time high as well. The Nikkei index is all-time high right now. Does this sound familiar? Well, yes, the US stock market is all-time high as well. The S&P index, 5,000 points, first time ever in the history. That is a big thing, guys, right? But does it mean the economy is also doing well? Well, from a GDP numbers perspective, yes, it is, because it is still above 3%. But if you look at the credit card debt, which is all-time high, if you look at the massive layoffs made by all of these big tech corporations, that doesn't tell you the economy is good. Right? Gone are those days when the stock market was kind of an indication of the economic performance. Like in the past, we have seen the stock market was always kind of proxying the economic picture in front of you, right? And we have studied in the books as well. There has to be some fundamental that is going to be reflected in the stock market performance based upon the economic situation. But those days are gone. Right now, the stock market is a casino, literally a casino, where the investors, the market participants in that market, is only looking for short-term gain, and if they get the cheap money, they will always rally to the moon. So this is the reason why whenever we see a bad news, economically bad news, but the stock market goes up. Why? Because the bad news means that the Federal Reserve will cut rates, inject the liquidity, which will pump the stock market again. So Wall Street, they need cheap money. They need cheap money to continue pumping at that stock market bubble even further. Okay, and if we get a good economic news, which means strong job reports or slower inflation report or slower PPI report, then the market dips. Why? Because that means the Federal Reserve will not cut the interest rate anytime soon. That means the Federal Reserve will not inject the liquidity anytime soon, which is why the market dips, right? So the bad news is actually a good news for stock market, but the good news is actually bad news for stock market. So that is the casino. That is the situation with the stock market, that it is a casino right now, right? It only goes up based upon the speculation, totally speculation, completely detached from the economic fundamentals. And even if you look at the S&P index, that is so much concentrated by the Magnificent Seven, the big tech companies who have been rallying the index entirely, but the rest of the companies in the S&P index is literally not growing. To some extent, they are in the negative territory. So what is the key takeaway point here? Well, the stock market is not the indicative of the good economic situation. Yes, the stock market is all-time high. It's still going up. The Nvidia is still pumping, but that doesn't mean that the economy is good. The economy is growing. And much of that stock market growth comes because of the passive investing. All of these hedge fund owners, all of these ETF owners, they all are putting their capital into the big tech corporations like Magnificent Seven. So if you look at their ETF distribution, they have much larger portion going into these Magnificent Seven, which is basically one of the reasons why these stocks are still rallying, because every single investor, big investor, is putting money into that, and all of these passive investment going into these ETFs and mutual funds, and that money is being parked irrespective of the economic fundamentals into these Magnificent Seven stocks. So there will be a time when this will actually reach its peak. Maybe it's now, maybe it's tomorrow, maybe it's 6 months after, who knows? But when it reaches its peak, then from there onwards, it will not go up anymore. One of the news I wanted to share with you is now the pension funds are investing into Nvidia, and that with the leverage. So when you have companies like pension funds and hedge funds taking leverage and going into these speculative, very expensive stocks like Nvidia, what do you think is going to happen next? So that is the last stage when you see that the capital flow into the stock market. They don't have enough capital left and they're taking leverage to get into these high performing stocks, but has to stop at some point. And when that point comes, I don't know, but eventually this will run out of steam and things will come back to reality. Because if you look at the PE ratio of Nvidia, that is 95%. That means the company is supposed to produce 90 times of its earning to justify its stock price. That is practically not possible right now. I don't know about 10 years. This is exactly what happened with Cisco in the dot-com bubble. Okay, whoever has the internet associated with its name, it was flying off the shelf. But then look at Cisco's stock right now, it comes back to reality. If I am the investor, I would stay away from Nvidia right now and any of that stock which is running at a PE ratio of 60, 70, 80, 90. Unless you have been growing like crazy, like Tesla. Like Tesla was that as well, but now it has come back to its mean version. Anyway, this is just me sharing my thoughts with you. You let me know what you think about that. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Bye.